Welcome to Property Banter. My name's Michael Lezaja, and in today's episode, we've got Hung Chuy from Strategic Brokers in the studio, and we're going to be talking about tricks to scale your property portfolio in 2026 and the things you need to know in regards to finance for this year. Let's go. Thank you so much for joining us.
No, thanks for having us. And, you know, in Bris Vegas, they call it.
Bris Vegas, they do. It's funny. We're both from the area and we're both out of the area now. Well, Logan's an area, isn't it?
We're back in the area.
So we're in another area. So for everyone that doesn't know, we're both from Western Sydney, and we both come from very humble upbringings in housing commission, and yeah,
I think
you're Miller and I'm near Campbelltown. So
I think I was speaking off air, and you know, from I guess where we were, I was trying to figure out which part of Sydney we were both. I thought for some reason we're both in Miller, which I think Spaniard done an episode about Miller, and you can see all the trap houses, and and I lived literally for about 4.5 years right next to all these trap houses. I used to just watch the guys walk up and down past our house. So it was we were quite comfortable there, but for some reason.
But it was normal.
It was quite normal, syringes, things, just people walking past, they'll be off their face, and I just thought it was normal. I thought that was the way society was.
Yeah, you think because it's around you and you're used to it. So I remember Cabramatta Station and getting offered heroin as a 10-year-old, right? And it's like, you want. As soon as the door opens, you want, and that was just, you just think that's normal. And
we'll put it into perspective into this chat today. I think like a lot of these areas which were really rough, if you looked at the price of entering these markets back then and how they are now gentrifying, and we'll probably brush into our property portfolio stacking in 26, because the amount of growth you could have made. Forget about the tenants that you're going to have. At the end of the day, you want to make the most capital growth. And some of these areas, if you go back 10, 13, 14 years ago, you would have quadrupled your money. So, and they're doing really, really well now. So, that probably leads into a bit of our conversation somewhere today. But the whole banter thing was, guys from the area seem to banter very well.
Yeah. We've got our jokes, and we've had some good laughs already this morning. But speaking of area, do you remember, people think when you're from those, not as affluent areas, that people don't have money, but it's surprising. There's still a lot of money in Western Sydney in areas that you wouldn't suspect, right?
It's a whole different world now. So like if you go out into the western suburbs, like say, I'll give you an example, it's Canning Heights, very Vietnamese driven area. Mate, there's Lambos, Ferraris parked out, somebody paid, I think it was a record price, $4-something million for a house there. There's some, there's a lot of money flowing around there. The reason I think that is the case also is because a lot of the migrant families, they've only had one opportunity in life. They're like, hey, you got to work your butt off, but they don't want to leave the area, right? So they've worked really bit hard. They became doctors, lawyers, accountants, engineers. They became successful business owners, but they stayed in the area. Yeah. So there's a lot of money still in the area, and a lot of these guys are actually earning a lot more money than people from outside of the area because they work their asses off. Yeah. And the disposable income's so much higher. So a lot of the businesses in the area are thriving because I live in the Northern Beaches now, which is
you got out of the hood.
I got out of the area, a little, very, very far away, and the disposable income then, like everyone puts all of their disposable income into their mortgages, or they don't actually have anything left over to spend. Yeah. So all of the businesses aren't thriving the way that they're thriving out west. Yeah. This was something I noticed anyway.
That's interesting. I didn't know that. Yeah. So it's funny how a lot of Western Sydney does have. It's quite common to have those exotic supercars that I don't think were as prominent or around when we were kids. Someone had a WRX. You had a blue STI or something like that back
blue
in the day.
S2000.
S2000. There you go. So those type of cars were around, and then it became the Mercedes AMGs in the 2010s and whatever. But in general, that was the WRX. And then if you go back, it was even Holden's, Gemini's, whatever, right? But gradually, everyone's become more affluent out west.
Yeah. No, it's definitely changed a lot. So
yeah, for sure. So in today's episode, I want to break down for everyone what's happening in 2026 and what they need to know. And this is following on, if you haven't watched the episode about the 2026 playbook where I talk about the types of properties you need to buy. We're following on from that, essentially a finance episode that's going to, we want your input here. We want everyone at home to get some really good value about what they need to know moving into 2026 with some of the changes coming, potential interest rate rises. We don't know when they're happening. We don't know what's going on. But you know what? We need to know how to play the game, right? Because essentially this is all a game of finance and property, right?
Yeah, 100%. Well, I think, I listened back to that episode before we came in today, and I thought it was a fantastic episode.
Yeah.
You let a couple of cats out of the bag in that episode, which I'm sure you've mentioned it, where people are quite familiar with where you're buying and what you think about property, which really resonates with what I think about property also. But the core of it is, this is a year of affordability.
It is.
Intrinsic value, I don't know how long you're going to see this intrinsic value out there, but it seems, if I go back in time for the last, forever, there's always somewhere to buy where there's intrinsic value.
Yeah.
So you named a few hotspots there. And I think where I guess people are going to get held up this year is they're sitting on the fence too long. They're thinking about what the next move looks like, thinking about, look, my bank can only give me X amount of money. They haven't explored further options. They haven't thought about maybe selling some properties that have actually done their job, which is something that's really hard to do sometimes. But if you could sell one property to buy 4 intrinsic with really good intrinsic value properties that will yield better, grow better, and give you a much better result, is that not worth it? So there's so many different ways to skin a cat, and obviously, there's not one size fits all for everyone, but we'll play around with it to try to give people as much as we can.
100%, and I think that the value, when a property's had that dramatic amount of growth, and it's time to recycle that a bit, buy in a couple of different areas in markets that are emerging where there's significant growth coming. Sometimes you need to take that win, cash out a bit, reset and go again. But this is another reason why having a look at your portfolio is very important, to do a portfolio assessment regularly, every 6 months, see how everything's going and see what you can do to improve your strategy.
Yeah, 100%. And I think that's leads into, I guess, the core of our business and what we do. I like to think that we're more than your typical broker. Your typical broker, here's your finance, we're going to get a commission, that's it. Our idea is to build clients from day one to be lifetime clients, right? So that we're kind of the centerpiece to help you make decisions. So we'll look at a portfolio and kind of think about, well, what's done its job? How can we place the next transaction to allow you to do future transactions? Are there lenders outside of the mainstream that are going to allow you to push it now with an exit strategy in the future, for instance? To give a really solid example, I've done that myself personally. I'm selling a property in 2 days. I haven't done my tax returns yet, so I had to use a really aggressive low doc funder just to settle this deal, because I knew that the deal was way below market. I've got about, I think, probably 80 grand equity before I settle it. It's going to cost me an extra 10 grand in cash flow to hold it for 12 months to use this funder. So I don't really care. I'm 70 grand on top in 12 months guaranteed by settling with this funder, but I know I'll get my tax returns done in the next 2 months anyway. And then that will allow me to refinance it back to a mainstream funder. So things as simple as, sometimes people just don't think big enough. They just look at what's happening today. And then also looking at the rental yields and the rest of it. They're looking at today's rent. What's the future rent look like? So you, depending on where you're buying, and I think we were talking off air just then about Melbourne rents and how tough they are at the moment and what that looks like. So I'm not putting forecasts in there, but I know what it looks like, because they lost such a large amount of population for the last few years, and they're finally getting that surplus. So I wonder what that looks like in the next 3, 4, 5 years when they haven't built fast enough and they've got this massive surplus. Well, that's only going to do one thing: pressure on prices, pressure on rent. At some point, you can rent a 4-bedroom house, bloody, in Melbourne for less than $500 a week. It's crazy.
So cheap. Melbourne is so cheap for such a big capital city. The fact that it's so cheap is amazing. It's the value for money, and the value for money comes from what went on. We all know what went on, and then everyone vacating and taking off to Queensland. It is what it is. But going back to what you're talking about, I just went with, I don't know, it feels, with my interest rate, it feels like a 10th tier lender, right? It feels like a loan shark, right? I'm actually getting smashed on interest rate, right? It's stupid. But I know the upside of the project I'm doing, and it's absolutely amazing. So I've just done the same thing you've done. And I think I want to highlight to a lot of people out there that the cost of doing business is very important, right? That if you've got an interest rate that's considerably more, and it's going to cost you, like you said, 10K, the upside 70. Is that what that's?
So 80 up, 70 net. 70 net. Done.
Well, it makes sense. It's the cost of doing business. And I think we focus a lot on interest rates, and this is what we were talking about earlier. We focus a lot on interest rates when interest rates to investors like myself or yourself, a lot of the successful 1% investors, we don't focus on whether that's up or down 0.25 or 0.5 or whatever it is. We're holding property for the long term because of the compound effect, right, and the capital growth. The little bits and pieces, the bumps in the road are insignificant.
I always say this, and it's always been my philosophy around property, is that you got to look at it like a business. So if you understand business, you understand there's a couple of measures, right? There's a balance sheet, there's cash flow buffers. So we always kind of put all of those pieces together, right? So the cash flow buffers, people, I think I have this thing I always say about chewing its own fat. So people always stressed about the monthly repayments, the ingoings, outgoings.
Yes.
I'm like, leave enough buffer in there that you allow it to chew its own fat. Look at the net result at the end of it.
Yep.
Like in that circumstance, I know that I'm going to be losing money on this property for the next 12 months, 24 months, until the rents catch up, interest rates do whatever they do. But ideally, I'm looking at that as a business transaction. You know, look at the net result. And what's the worst case scenario for me? So what's the exit? The worst case scenario is I'll sell it and make a profit. You know, so
exactly.
If that's my worst case scenario, because that means you're entering well, and then you have all ability to exit whenever you need to. But at the same time, you don't want to exit when the market's still running. Let it do its job and exit when you need to exit, or exit when it's a good opportunity to do other things. But don't exit just because you're trying to beat the market or beat future rate rises or whatever it is. You want to be buying property that's, right, I guess, rate proof, right? In the sense it's going to go up if rates go up. It's going to go up if rates go down. It'll probably go up more aggressive if rates go down.
Interest rate proof real estate. And that's that affordable. And that's what we talked about in the 2026 playbook, right? Affordable real estate that's got restricted supply, high demand, lower entry price point. It's affordable and it's got plenty of room to grow. It's a market where investors will buy. It's a market where first home buyers can afford very easily, and owner-occupiers are buying and upgrading. And a healthy market has all sectors covered, right?
100%. No, I totally agree with that.
Yeah. And going back to the other thing you were talking about was looking at the interest rates. There's plenty of investors I know, and I'm sure, let us know what's happening on your end, but a lot of investors that are quite intelligent, they're very analytical. I find that they can sit on the sidelines and they will analyze their repayments right to the dollar, and they will do a million spreadsheets and so on and so on. And they don't pull the trigger, or they don't take action. I know people that are sitting on millions of dollars that can't pull a trigger. There's a psychology behind investing. And then I see people that don't actually look at a spreadsheet. They're just like, yeah, I'll take one of those. I'll take this. I'll buy it. I don't care. And it's like that. And then you look at there's these incredibly smart people, what you consider smart people, not investing. And these people that they might consider not as intelligent as them, making all the money. Yeah. You see that?
I see it a lot. And it's I think, as you said, it's a mindset piece, actually. But sometimes when you think way too hard about a transaction, it's, what do you call it? Analysis paralysis in a sense. You really just got to look at your raw figures. I'm a combo thinker. So I'll do the numbers. I won't go down to like a cent or a dollar, I'll buffer thousands and go look up or down. But I'll always keep a massive cash flow buffer. This is the way I operate it. I'll sell or I'll generate income from my business, and I'll just stash a whole crap load of money to know that, look, at the end of the day, it will chew its own fat. If the worst case scenario, I lose tenants, rents coming in from my other 20 or so properties, or they're not coming in at all, that how long can this match the repayments for? I've done it in a way that it will allow me to keep running for a very, very, very prolonged time. So as much as people might think that I'm a very risky investor, actually very risk adverse when you look at it, because I've created a buffer so substantial that it allows, no matter what happens for many, 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 many years, I could let these things be vacant and let it run its course, because I know the capital growth is still going to run. So I always encourage that with all of our clients, is like, it's the buffer. That's probably the core to building a substantial portfolio. And then comes the structures, right? Whether you're going to build a structure that will allow you to keep growing, or you're going to just buy a few properties, and that's, your end game is to retire with X amount of money. A lot of people would say to me, they're like, I'm going to be comfortable with 100 grand passive income in retirement. I don't know. I don't know if you are going to be comfortable with that. Everybody thinks they can get away with a certain amount, but the truth is, you don't want to dial back your lifestyle to retire. No. You probably want a better lifestyle to retire, right? Yes. You want the same, or if not better.
So you should be more aggressive earlier.
Correct. So if you got time on your hands, that's the time when you want to be more aggressive. Not telling people to go shoot the lights out. or if you're going to shoot the lights out, have a really good team, right? So if you don't have a really good team, then be very careful trying to pull this off yourself. Go to people who've done it themselves. They've got skin in the game, doing it day in, day out, and just constantly structuring finance, buying property, structuring finance, building buffers, buying property. So it's like you said, game of finance and houses, just keep stacking them up.
It is. So going back to that, it's funny you said the $100,000, right? Because $100,000 was what everyone used to talk about. Every property investor was like, I want to make $100,000 passive income, and if you want to, and then when they're advertising in the ads, it's always like 100,000 passive income is the goal, and 100,000 doesn't get you far. So aiming for just the bare minimum that you would need to live today is not how you should be attacking this or looking at it or planning for it, because at the end of the day, since COVID, we've received a very good education, all Australians, in the power of inflation and the rise in the cost of living, right? So it's very, very important to make sure that when it comes time for retirement, that you're covered, you're well covered, right? Because it's too late to start building then. Right? You should be building now.
100%. And I've noticed, so there's a lot of ways to play it when you get to the passive income side. A lot of people want to move all of their assets into commercial. Heard a couple of guys earlier talking about move it into one big core asset. I'm like, I don't know.
I don't like that idea.
I don't like that idea.
Okay.
But I was like,
all right, let's get on to this.
I was looking at going, what are you talking about? Imagine you had one core asset, right, and things fell apart.
It's not rented.
You need to do renos for your next tenant. You don't have the cash to do it. I'm like, no,
that is
terrible
idea.
That
That is poor advice.
Terrible advice, right? So once you move into that stage where you want passive income, you want to have multiple assets, spread across multiple areas, multiple diversified in different assets, like different property classes, areas. I don't know. I think that's a better way to get it there, and that way, if something becomes vacant, then you can work on that.
I think so too. But if you want that big asset, right? If you're chasing that, I want that big $5 million, $10 million commercial. If you do enough to get it, that's fine. Have it, but still have quite a few different income streams as well, mix of whatever it is. But just to have one being, this is my sole property that I'm relying upon to feed me. In my in my retirement, no.
And I'm very obviously massive property advocate in a sense, and the reason being a property advocate is because of the power of leverage. But when you don't need the leverage no more, when you're trying to go backwards, then you do need to have the crap load of cash at bank, right? Whether you go into shares or whatever else you want. You need something that's going to allow you to, if that place falls apart and you need to get a new tenant, you got to spend $500,000. Where are you going to get that from? You don't have leverage anymore. You've got this property there generating income. You don't have cash at bank. Who's going to lend you money? Well, you got lease stocks and things like that. But look, at the end of the day, I think if you are moving into that or transitioning into that passive income, no longer work phase, I think I don't know what everyone else thinks, but I think you need not to think about how much you need and maybe double it.
Yes,
that's what the way I think about like what your end goal looks like. So my personal end goals, I'm looking for a very, very substantial passive income, probably way beyond my means, but it's generational wealth which we're trying to create from there. But imagine you could feed the next 20 generations based on what you've built. So,
but you could also get a rainy day. So if you do plan for that $100,000 and you know that that's your limit and your budget right now, and you're living on it now in today, 2026. That 100K is not going to get you far in 2035, 2040, and then the rainy day happens and you're in shit all of a sudden, right?
Oh yeah, 100%. Well, that's the one good thing about commercial property, I guess, in a sense, is that it's always built with inflation.
CPI.
Yes. So it allows to grow with that, but at the same time, if you only have one core asset, you kind of want to spread it out. And as we came out of COVID, we saw rents rise, but that's not going to be the same market. We're going to figure out how to fix this supply issue at some point. So you're not going to get these crazy rises. They'll just cookie cut and print more homes for everyone,
I think it's not good it's incorrect to assume that we're going to have the same market all the time.
No, 100%. The market's always changing. And I think adaptability is the core to, I guess, property, finance, all the rest of it. And like we were talking off air, there's been a lot of changes in the finance space. So it's constantly changing, and what worked last year doesn't work this year.
So let's get into that.
Yeah.
Fantastic segue. 2026, looking at rate rises. We've already discussed the fact that we don't focus too much on rate rises. They're a part of the game. Wherever they're at, so be it. But there are lending changes happening here and there. We as we've seen at the back end of 2025. What are you seeing happening, and what are some of the main things investors need to look out for moving into this year?
Yeah, so I think the two core changes which happened at the end of last year, was the fact that the banks are now, or deposit-taking institutions are now limited to having 20% of their books being any higher than 6 times your debt-to-income ratio.
Yeah.
Right. So if you earn, let's say, $100,000 a year, the maximum they can borrow or let you borrow is $600,000, which is 6 times $100,000. If you have a rental in there, obviously you get that rental, let's call it $20,000 a year, times that by 6, that's another $120,000 that you could borrow. So very limiting on. But the truth is, funny enough, that doesn't change too much because most calculators won't let you go above 6 anyway.
Right.
Unless you're self-employed, you have a few things that you add back in there, it doesn't change it too much. And if you needed to, you should go to non-deposit taking institutions anyway, because they'll allow you to calculate it a bit differently to allow you to push beyond that. And they all have different algorithms, which is funny, and how they determine that 6 DTI thing, which they're all tweaking as we're speaking, to make that work a bit more efficiently for, I guess, or allow people to borrow a bit more. But it doesn't mean that they're not taking you if your ratio is above that. They're taking 20% of it. You've just got to go through a bit of heaven and hell and go through what they call senior credit to sign off in order to get the deal through. So that was the first major, I guess, announcement. Whether it changes much or not, I don't think it's going to have a big jab on the market because we'll just go to a non-bank whose rates are probably the same, or if not, maybe even lower in some cases. So if you go to a good broker, they'll understand that, and they'll look at the right places to place you. Yeah. Second major one, which is for the professional investor or seasoned investor, is the fact that a lot of the big lenders are pulling out of trust lending, or they're adjusting their policy around trust lending. So leading up until the end of 2025, there was a lot of guys buying in trust in order to quarantine the trust, which means that the trust is at some point profitable, which will allow them to go to another funder, for instance, or the same funder, to ignore all of the liabilities from the first trust. So that's really big news. The reason why they've put up on that, because it was, I guess, in some essence, it was a very loose policy, and I always thought it was a bit too much of some of these guys. If you're truly quarantining the trust, then great, and get that to a level where it's it's making its own profit. Why do you really need to look at it? It doesn't really bother them. Obviously, when rates rise, that could change, but as long as they're getting the right formulas to prove it profitable, then that's all fair and good. So I'm all for the trust lending. If you are buying or trying to build a substantial portfolio, really got to get that accounting advice, because in every state, a trust is treated very differently for land tax purposes, treated very differently for when you do, I guess, acquire the property, or if you do sell the property, and how you distribute capital gains. So you've really got to think about how that looks on the accounting side. But then if you're looking at the big picture, if you are buying in a trust, it allows you to at some point quarantine it and go to maybe a non-deposit taking institution who will allow you to ignore it and buy more properties. If it allows you to go from holding 6 million in assets to holding 10 million in assets, the exposure is much more substantial. So it's something that I would say, get the advice, explore really well with a broker and an accountant on how that might play in your circumstances. But it's not a one-size-fits-all box, that's for sure. No,
definitely. So obviously not financial advice, but if you were starting out right now and you were on the 100K and it's 6 DTI, right? Debt to income, that's how it's serviced. You get a $600,000 loan for an investment property. Would you, once again, not financial advice, just your personal opinion, would you go straight into a trust structure for the protection of borrowing capacity if it was you personally and you're starting again today?
It depends on how aggressive I want to build this portfolio out, and also going straight into a trust. Some lenders are a bit more expensive. You've also, you've got to work out the cash flow on that side as well, because it can cost you a lot more. Yep. And depending on which state you're buying in, then you go, well, look, some states, for instance, charge a surcharge on trusts. So to give Victoria as an example, the land tax is from day one. You go to states like Queensland, and each trust has its own land tax threshold, but it's also got a lower threshold. Yeah. You go to New South Wales, and a trust is deemed taxable from day one unless it's set up specifically as a special trust, which is then a unit trust. So there's so many, not accounting advice, but you've really got to look at state by state, go from state by state to then look at, okay, well, what are my future plans? If you can only borrow $600,000 plus rental, that's $720. Let's call it, with the $20,000 per annum rental, and you want to buy your first property $600,000. How are you going to get to your second property? So that's where we get a bit unstuck. You go, well, is my income going to increase over the next few years? And when do I want my second property? How much actual cash do I have? And is there a way for me to get this trust profitable at some point? So a lot of hanging questions. So there's no fixed and fast answer to it in the sense. If it was me personally and I knew that I could increase my income and I wanted to build out a pretty substantial portfolio, I'd probably look at all of those measures, get all of the advice, and then I'd probably think about buying in a trust personally because I would go, well, how do I figure out a way to buy maybe multiple properties, maybe sell one or two at some point and then reduce some debt facilities or reload a commercial property in there to allow this trust to quarantine itself and then allow myself to then maybe start buying some more properties.
Yep. Fantastic. So tell me about, obviously you see a lot of property investors and you see the top 1% and the one in which they scale. How many of them are utilizing trust structures for the majority of their portfolio?
I think anyone in the top 1% is using a trust structure in some shape or form or for some properties. Even, if they're just buying a commercial property, for instance, you always buy in a trust structure or a company structure depending on, which state and what the need or requirements are of that state. But everyone in the top 1% are using these structures in some shape or form. Yeah, it's that's what I'm seeing as well. It's one where a lot of people that are coming into the space are researching, and hence why they're going to probably love this content. And it's showing that that a lot of those are protecting their borrowing capacity, and they are getting those letters. And Macquarie Bank was smashed with how many applications they had last year. Do you feel that was a Macquarie Bank decision, or do you think that was an APRA decision? I think it was an APRA Macquarie. It was crazy.
I'm putting you on the spot. I don't know. I want to know this answer.
I think they blamed it on finfluencers and talking about the unlimited borrowing capacity. It was all over. If you go on Instagram and just go unlimited borrowing power, it would have been like 500 reels of different people talking about it, right? It was such a loose policy out there at that point in time. It allowed clients to self-declare trust to be profitable, which it didn't sit well with me, to be fair. And I always looked at it going, well, how can a client self-declare it? You got to nail down the numbers. It's got to be profitable in order for it.
It's basically like an area job. It's like, are you good for this? Yeah, it's all good. No worries.
Yeah, like an area, right? We shake hands. Yeah, we're good.
It's done.
Cousin never pays you back for 20 years. It's that kind of principle. But I think
everyone's got a cousin from the area that owes them money.
Yeah, I've got about 50. No, I've got friends, cousins, brothers. It was a very loose period for that because at every part of the property cycle or time or every time in the market, there's always something. I don't know if you noticed. Like if I'm for those who haven't been in property for that long, like if I go back to 2009, 2010. Right, there was a major lender out there who used to lend you 80% at big bank rates on the back of an employment letter, as long as it had a signature from the director and an ABN on it. Think about how crazy it was back then.
That's crazy.
Yeah. So the whole.
But what's the servicing on that then?
It's based on whatever income was stated on the letter.
And that's it.
That's it. And it was 80% up to $3 million. Like it was crazy, right? When you think back.
But then they don't cross-reference your bank statements? It's just a letter.
No, I'm going back and the world was different back then.
It was, but it was
a letter and a 4-page app pack, and that was it. And that's the way that they used to make money. It wasn't something that sat well with me either, but it was. You could walk into a bank back then and just get a loan approved based on that. It'll take them 5 minutes basically to get you up to $3 million. Yeah. But the world keeps changing, right?
It does.
So, not to say that loose lending is the way to go, but I think the big picture is. I guess finance is just part of the game. It's what you actually understand or the knowledge base that you have, and treating it like a business, understanding those elements and going, how am I able to obtain the cheapest amount of finance to allow me to scale my portfolio to the largest? Because the more exposure, I always use this example, to good debt, to good property, you're going to get a bigger return, right? So put in perspective, if you have a $1 million property portfolio, I don't care what your debt level is, and you made 10% this year, which if you use Michael, you'd outperform the 10%.
We averaged 28%, by the way. I'll just throw that in.
Yeah. So let's use 10% as an example. Okay. It's very safe.
Yeah.
Okay. If we use 10% example on $1 million, then you're going to make $100,000.
Yeah.
Who cares what your debt level is? You made 100 grand, right?
You're up.
If you outperform that and you get, let's say, 28%, you made 280,000.
Yep.
If we scaled our portfolio now somehow and built it really, really well with really good finance strategy, somehow got that to 10 million, right? And now we're talking, right? So you go 10%, that's $1 million this year.
Yep.
Let's go 28%. Let's use your average and go, that's $2.8 million.
Yep.
You made $300,000
So like
a year.
60 G's a week?
Right. You are out. Imagine you're multiplying your income by almost 10.
Crazy.
Just on the capital gain side. So,
it's very powerful. A lot of people don't realize.
So powerful.
Yeah.
The day I realized, I actually didn't even think about it that way for a long time until I can't remember what it was, maybe 7-8 years ago or something like that. And I thought about like, I need more exposure.
Yeah.
So that's where the clock started ticking, and then you're like going, oh,
Wow,
let's go. Let's just keep going.
Yeah.
The further I could push it, everyone's like, oh, that's so risky. I'm like, no, it's not.
It's risky not doing it.
Yeah.
It's risky not doing it.
For me, the only risk was that my cash flow buffers would chew down. Once you got to a level which I was a bit uncomfortable with, just sell one property.
Yeah.
As long as your properties are not cross-collateralized, which I think we briefly touched.
It's a great
you
point.
can just exit one property. This is a big problem that people face. They go to a banker. No, my private banker has me, man. Yeah. No worries. You got 15 properties all crossed into each other. You can't sell anything, bro. You
can't do a
There's
thing.
nothing. You can't exit. You've got no cash flow buffers left. You're in trouble.
Yeah, and now if you've pushed it, right, and you've pushed it and your cash flow buffers are incredibly low, something happens externally in your business, with your family, whatever, you need money fast. You can't get it.
No, everything's co-linked. I've seen this. This is what I've seen empires fall down, right? GFC. And
this happened to me. I've been through this.
Yeah. One of my closest friends, his dad lost, he had 100 million exposure. Went to bankrupts during the GFC because everything was linked: business, construction, developments, retained properties. So I've seen don't link anything.
Yeah,
everything is standalone.
Yeah, and that way you can move it, sell it when you need. Right. So what's right now the biggest mistake you're seeing investors make, and how should investors avoid this right now?
I think the biggest mistake that investors are doing is they're just going to the same person without really thinking about, I'll say same person, same mortgage broker, same bank, using somebody who hasn't got skin in the game. So somebody who hasn't built out a portfolio themselves or been in a similar position to the person who's trying to achieve bigger goals. So I think this is for purely investors or people trying to build out substantial portfolios. So you really need a team or people around you who have done it or who are doing it for themselves constantly. So that's probably my first thoughts, because if you go to your everyday broker or your everyday banker, they're looking at you as dollar signs and cha-ching, transaction. I'm just going to get this transaction done. I'm going to get paid and so forth. You need somebody who's looking at you as, we're going to make this lifetime commitment. And for people, I'm not trying to, plug my business as such, but I've trained everyone in my team with the mindset of, we are not transactional. When we take people on, it's a lifetime partnership. If we lose them, then we've done something wrong. That's on us. So the idea is to go, hey, well, what does it look like today to allow us to get to where you want to be in the next 10, 20, 30 years, right? So that's a really core part of, and to break that down now even further, it's, okay, for instance, you own one property, you might only have 100 grand equity in there. Your broker or your bank says, oh yeah, look, I've done the valuation, there's 80 grand we can pull out. Yeah. Whereas my team will look at it and go, hey, I've done the valuation, I looked at 13 different funders. I've actually got a valuation that's 200 grand higher than this guy, this other lender. We can actually pull out 160. You don't have to pay mortgage insurance. You can buy another property. We can structure it in a way to buy another property, whether it's going to be in your individual name, or we can start thinking about what the next plans are to go, hey, we're going to buy in a structure. At some point, this property's done good growth, but it's probably got another 2 or 3 years worth of growth going on here. Maybe talk to Michael, see what that looks like, what the forecast kind of looks like on that marketplace. At some point, we might sell that, reduce debt, buy some more property. So, getting into a bit more depth or thinking about your long-term play rather than just transaction. I can't borrow any more money. I'm stuck. Yeah. That's the typical scenario that we'll see. So I think, that's the biggest mistake of an investor makes, is not selecting the right team or thinking about, or they're just using their broker because they're their cousin's friend and they feel bad. That kind of thing.
So I see that. I see people go, okay, I bank with this bank. So, I've spoken to the person there at the counter. My mum used this mortgage broker and they're good. But they don't know what really good is. Until you work with a broker that's really, really good at what they do because they've scaled their portfolio, they understand all those nuances and strategies, right? Strategic, right? Those strategic strategies, right? Of going to those 13 lenders and finding that bank that's going to get you that valuation and working for you to achieve that outcome. That's why when people usually come to me, they recommend a solicitor, they recommend a broker, whatever. The majority of time, a lot of my clients that come on board have it wrong. They're using the wrong people, and they might be the nicest people, right? So this has got nothing to do with character. It's just that their skill set isn't quite there to deal with or to be at the level of the top 1%.
Oh, 100%. If a client came to me 10 years ago and they want to scale portfolio, I was not the right guy.
Yeah.
So,
that's being honest.
I'll be honest. Like I was not the right guy. And then I really only scaled the portfolio the last 6 or 7 years where it started really growing.
Yeah.
And we had to achieve, milestones.
Yeah.
And I've seen what happens when things go right and wrong.
Yeah.
So it's, and everyone in my team are trying to scale their portfolios. They're constantly buying. Our team is on the constant buy mode.
Yeah.
There's always a good market to buy in. So.
There always is. And 15,300 suburbs.
Yeah.
It's like, it's capitalism, right? Where someone's making money, someone's losing money. The stock market, someone's making money, someone's losing money. There has to be a trade-off. It's like energy, right? Money's energy. Property prices are going up somewhere, even though rates might be going up and, an expensive house in Sydney might not be going up, but there will be a market somewhere where someone's making money. And I suppose that's where I plug myself, right? You can use a good buyer's agent.
No, that's right. I've actually looked back since, I guess, I started looking at property. I spent this time just reviewing, going, every single year there was somewhere to buy with really, really good growth.
Yeah.
And we were just talking about off air. We were talking about, Mount Druitt's back in the days.
$200,000.
Then we went from Mount Druitt's to then there was opportunity in Logan.
Yep.
Went from Logan, then there was opportunities, where do we go next? A whole coastline of Perth.
Yep.
Pretty much you could get positively geared properties on good blocks of land, way below intrinsic value. And then, you let the cat out of the bag in your last episode talking about the NT side of things.
Yep.
So that was quite interesting.
Yep.
Because you could still get properties at like sub $650 with $800 a week rent.
NT's still a buyer, in my opinion. Yeah.
So it'll be interesting to see where the market plays there this year. But there's always someone to buy where there's really, really good value. So it's
always.
If you're getting all your ducks in line, get your buyer's agent, get your broker, get your strategy done. Look, the conveyancers, everyone else is kind of their own world. Good accountant, solid advice. Everyone thinks they need a financial planner, but if you're a property buyer, you really just need to understand property strategy. Financial planners, predominantly insurance brokers, if you look at it in the real world.
Okay, I'm glad this is being brought up, right? I'm glad you brought this up. Financial planners, I've dealt with some amazing financial planners I've seen out there, but a lot of them are educated in insurance and stocks. Yeah,
that's it.
Fair to say?
That's it.
That's not what we're doing.
Yeah.
So if a financial planner has a lot of, has a great deal of an opinion, a biased opinion in one way or another with whatever it is, unless they've built and scaled a portfolio, I don't put too much stock or weight behind that particular opinion, right? The best people to learn from are those who have done it. End the story.
Yeah, no, 100%. I've seen so many people it drives me nuts because I've seen people go to financial planners, come out with this whole plan, and like that plan's going to cost you money and not make you any money.
Yep.
Not allow you to leverage, because leverage is the core, which we bring back to.
Yep.
Right? It's the ability to go, well, I now have exposure to 10 million instead of exposure to 1 million.
Yep.
And they're showing their results. Oh, yeah, we outperformed the market, made 13% year on year. I'm like, mate, you made 13% on non-leverage.
Yes.
So your 100 grand made you what? 13,000.
13,000.
You put 100 grand, we leveraged you up to $1 million. We made you 130 grand in that same year.
Yeah.
I'd rather make 130 grand than 13 grand.
It's 10 times the money.
Yeah.
It's 10 times the money.
Exactly.
So it's chalk and cheese. I did a video on how we outperform the stock market, and it was absolutely ridiculous. I think it was one where we started with $60,000. I think it was 2018 or whatever it was, and we leveraged into converting a 2 to a 3 bedroom here in Eagleby for $200,000.
Yep.
Extracted that equity, bought another subdividable renovator, extracted that equity out at 1,000 square meter Red Bank Plains, and then we leveraged that to buy a 13 townhouse development site once again in Eagleby, and they had from $60K to a $1.2 million portfolio pre-COVID. It made $250,000 each year on year. And I did the video last year. So $250K each year on the $60K invested 7 years ago. You can't do that in the stock market.
No. Nah.
I've got to link that video somewhere. It's a good video.
If you left that 60 grand in the stock market, what do you reckon? Versus what you
I did it. I chat GPT'd
Yeah.
it. It was pretty poor. So it was like 100 and something thousand. But yeah, so we're clear and in agreement. The stock market can never outperform what we do in real estate. It's just not possible.
Look, it could if you bought.
If you
bought a penny stock and you got lucky, you hit the lot of the
Nvidias?
0.00001, and
Yeah.
you know you bought something ridiculous, but that's not going to happen.
I wish I bought
Lotto.
Bitcoin. I wish I bought Bitcoin in 2010. Just $100 worth.
Oh mate, there's so many of those jackpot moments, right?
Yeah.
But buying good property, as we know, it's the core fundamentals. It's buying below intrinsic value, having that in your bank. What's your worst case scenario? If the whole world crashes, you have homes that are below intrinsic value. You can't replace, can't rebuild that house for the price that it's that you bought it for. Your worst case scenario is that you sell it, you wait for it to go a bit higher, or just sell it and make a profit anyway. So
that's true.
It's quite bulletproof, and the leverage allows you to just get so much more exposure.
And when you're buying in areas that are undersupplied, that have demand with low vacancy rate, it means people want to, people need to rent there. It's solidly underpinned there, and it's I believe a safer investment when you make sure that all of your metrics and fundamentals are ticked off, right?
100%.
Fantastic. So I appreciate you coming to the hood.
Yeah.
And having a chat. It's been great.
From one hood to another.
Thank you. Thank you. For anyone who wants to catch up with the strategic team, we'll put a link in our description?
Yeah. We'll put something in. Or
I've got a mental blank.
Or find Strategic Brokers on Instagram. Just link up there. A lot of people have just been Strategic Brokers. Find us on Insta and just follow us. And we'll try. We put random. I'll do a waffle once a week, which is always something relevant to, I guess, the times. People quite enjoy it because it's when you just watch one piece of content a week, and then you really start learning a lot. That's what people have told me. They go, man, we listen to the waffle once a week, and we're like, man, I've watched it once. I'll tune in and watch it. It's always something relevant for the week, So if something that comes up on our desk is quite unique, and everyone's like, oh, didn't think about that. It's always a mindset piece, almost.
Yeah. There you go. And strategicbrokers.com.au.
Correct. It's strategicbroker.com.au.
Broker.com.au.
Because I couldn't afford the S, because some guy's trying to roll me for the S.
Couldn't afford an S. Didn't you have McLaren?
Nah, but...
Great chat.
Grew up with scarcity mindset, so I can't... Not paying an extra $10,000 for an S.
No, fantastic. Thank you so much for joining us. For everyone at home, thank you for tuning in. Please like, share, subscribe. Get in touch with us if we can help in any way. And until next time, take care.